Crude oil prices, are they going to rise? Or are they going to fall? You know, about 5 days ago, I said around the 22nd of August, crude oil prices start to rally and go up quite dramatically in price. And yet, here I sit here on a nice Wednesday afternoon, and I was wrong so far. Oil's trading at about $82.58 this afternoon. It was as low as $80.25 West Texas pricing as of yesterday afternoon close. So the question begs, why would so many people like myself keep looking at the fundamentals projecting higher crude oil prices? There has to be something more to it than just prices dropping, even though there seems to be no relief to the Strait of Hormuz supply issue. Well, let me give you what I think. I think we have what we call a boiling frog syndrome. And that simply means that by every statistical analysis, we're running out of refined product. We do not have enough raw crude oil being produced around the world to match demand. And what we have is fundamental implementation of additional supply or demand destruction that's balancing the current market. But I liken that to being like a boil on my arm. You know, I know it's a boil. I know it's going to hurt. I know it's going to pop sooner or later. But I keep saying that, and it hasn't quite festered to the point where it actually happens. So, what's taking place in the market? Why are we not seeing this supposed breakout in prices that would be more in line with what the economy is suggesting, the global supply and global demand are suggesting? Why is it we're sitting at $82.50 today? In my view, we should be well over $100 a barrel based on pure fundamentals. Here's some of the factors. When you look at the boiling frog, you put a frog in a pot of cold water and you turn on the fire. And it's getting hotter and hotter, but the frog becomes comfortable with it. And the frog gets used to that particular rise in temperature. And it's not until it's too late for the frog to get out of the boiling pot of water that it ends up dying because it's been boiled to death. Well, here's what we're facing. We took that big pot of cold water, which was called balance in the global supply and demand back before the war started. We had a major interference run by the President of the United States by saying every single week for about the first 90 days, don't worry, the war is going to be over. Don't worry, Iran's going to give up. Don't worry, we have an MOU in place. Don't worry, we've got them locked down. We're going to have all this back open. Now the messaging is, don't worry, we have naval vessels taking oil Aframax carrying crude oil in millions of barrels at a time through the strait, doing 4, 6, 8, 12 million barrels a day that's being reported. Well, think about that for a second. Do you really have a functional Strait of Hormuz? No, you don't. What you have is expensive, incredibly expensive guided tours through the Strait of Hormuz with naval vessels that the United States is supplying to move 5, 6, 8 million barrels of oil a day. Now, if you had to take that military support and that U.S. naval vessel support getting those vessels through the Strait of Hormuz, what really would be moving through the strait? Zero, nada. So what we have is every effort by every major player who are trying to make sure the global economy does not go into a recession, doing all they can to keep crude oil prices down below $90 a barrel. Let's talk about China. China on two different fronts is affecting the global market. They have become the swing player. And the reason why they're a swing player is, one, they've been drawing out of their own supply. Number two, they've readjusted their consumption, and they've reduced their consumption by about 1.5 to 3 million barrels a day. So instead of having just this supply disruption, what we have now is we have actual end users that are modifying their consumption, taking out of their own reserves so they don't have to buy it on the open market. That lowers the pressure. Then you have traders. Traders are constantly measuring the probability of an end to the Strait of Hormuz conflict and war. And what that does, it means they look at the open market and say, am I better off buying contracted open market pricing? Or am I better off buying an Aframax that's already on the water and pay a premium for that? That premium paid for the oil on the open water is not reflected in the current trading price today. That's an aftermarket price. So when that oil leaves that particular producer and it goes into that midstream asset, that pipeline, that gatherer, that particular port, that is considered the transactional price for oil that day. It might trade multiple times before its end destination. So what the numbers are that I can find would show that open water vessels can be trading oil for as much as $125 to $175 a barrel. But we see in the paper, we see in the West Texas Intermediate pricing, we see in the Brent pricing, $82 to $85, $89 a barrel. And I believe that's a revelation of two things. Every single consumer out there has modified to the best of their ability without affecting a negative economic factor to the economy. What can we do without today? Well, if you take the top leading 20 or 30 countries that consume crude oil and they modify maybe 250 to 500,000 barrels a day of consumption, all of a sudden you make up a big differential in the 11 to 15 million barrels that's not being supplied. That number is kind of immeasurable, right? It's immeasurable because it's insignificant relative to one country or the one user compared to the entire global consumption market. Number two, China is a major consumer of crude oil. If they take 1 to 3 million barrels a day and they pull it out of their inventory, they've got about 1.2 to 2.2 billion barrels of oil between what the country, the Communist Party owns in China and the two major oil producers own in terms of storage. It's estimated between like 1.2 to 2.2 billion barrels. If they simply pull out 1, 2, 3 million barrels a day, it puts less pressure on the open market. That's 3 million barrels of demand that's artificially not in the market today. You then add in the fact China, who consumes probably second to the United States, the most consumption of crude oil in the world, all of a sudden now you have less consumption because they've cut out 1 to 1.5 million barrels a day. What's the moral of the story of the boiling frog? We, as those that believe we're experts in oil and gas and pricing commodities, we don't have the extra tools and the insight on that kind of minor demand destruction. We don't know what kind of barrels are being pulled out of storage by countries like China. What we know is that refined products, raw material, raw product, and every other statistical detail says we should be way higher in prices of crude oil today. And that way higher in terms of dollar amount says we should be $95 to $110 a barrel today. Now, I said by the end of the year, we could be at $125 a barrel. Here's the relevant point, and I'll make it short. We don't know where the price of oil is going. What we know is if you take out all the artificial stimulation to suppress crude oil prices out of the market, you're north of $125 a barrel by the end of the year. That's the facts.